This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello there, and today we're going to go through there and work our way through the analysis question that was contained within the financial reporting sample paper that's on the ACCA website, and this one is from September-December 2019. So the question is called Bun, and we have three parts to the requirement. Part A effectively is about calculating some ratios, isn't it? But the first point to note is that when you're calculating these ratios, you need to adjust for all of this information that we're given in note 3 down in the bottom left. So all about some slow moving inventory. Should have been sold at 1.5 million, but was sold at 50% of what it cost. So we'll need to make some adjustments there to our inventory valuation and then calculate the sector average equivalent ratios. So you have your sector averages here. Is it for the 30th of June 20x7, and you can see there that you have 5 ratios to go through and calculate: return on capital employed, operating profit margin, net asset turnover, inventory holding period, so effectively inventory days, and your gearing here, your debt to equity. Note that there are 7 marks available for part A, so I would assume that there's 1 mark for calculating each of the ratios and then 2 marks for making the adjustments. In part B, you've got the typical type of analysis question. You need to look at the performance, you need to look at the position of this company called Bun. Do just note though, its year end is 20x7, when those sector averages that we're calculating and comparing against are June x7. So that might be something we can take account of a bit later, but let's not worry about that for now. We're looking at the performance, we're looking at the position in comparing them to those June x7 sector averages. And then part C, it says explain, so don't just note the limitations, explain. So use the information that you've got within the question to go through there and explain the limitations, 3 of them, so 1 mark for each of the comparison between Bun and the sector average ratios provided. Well, straight away you've got one of the possible limitations, haven't we? Is that we're doing an analysis for Bun for December x7, and the sector averages that we're given are June x7, so that's a limitation because we're not comparing like for like, are we? So there you go, there's 1 mark. Put that in your own words and off we go. Okay, so what I'm going to do is, my aim is to record 3 separate podcasts that goes through part A, part B and part C. So let's kick things off first of all by having a look at part A. So we know we need to calculate the ratios. Let's have a look at the adjustment in note 3, and don't panic, because if you can't get the adjustment correct, not all of the ratios are going to be impacted by that adjustment. So have a go at the adjustment, get something and use your own figures and you'll still get the marks. Okay, so remember, we have a December year end date for our company Bun, and we're told in part 3 that in January x8, so note that's just after the reporting date, isn't it? It was decided to discount some slow moving seasonal inventory which had a selling price of $1.5 million. On the normal circumstances, these products would have a gross margin of 20%. So we could work out the profit on the sale of them. We could work out the cost of sales for those goods. But we're then told that it was sold in February x8 for 50% of what it had cost to produce. So given that the financial statements were authorised for issue on the 15th of March 20x8 per events after the reporting period, IS10, this is an adjusting event. We are going to have to adjust the value of the inventory, because at the reporting date we valued it at the lower of cost and NRV. So here the lower would have been the cost because we were expecting to sell it at a 20% margin, but now we've sold it at only 50% of its cost. So therefore its NRV is going to be less than its cost. So we need to work out what that NRV is and then go through there and make the necessary adjustment. So that's where the fun all begins, isn't it? So part A. So what I'd do is I would go back and look at my cost structures. So sales 1,500, cost we don't know, profit we're unsure of either. Because what we're trying to look at is we're trying to work out what the cost figure is, aren't we? That's important. Well, we're told, aren't we, that as a percentage, it's there, is it at a 20% margin. So if that's the case, the costs are going to be 80% of the 1,500. So 80% multiplied by 1,500, does that give me a cost of 1,200? Okay, so that's what it would have cost to purchase those goods. The NRV, however, what we sell it for is 50% of the cost. So is that 50% of the 1,200, which is there as 600,000. So that 600 is the adjustment that we need to make. What is that adjustment to? Well, we need to go through there and reduce the inventory. So again, you don't have to write this down, but we're going to go through there and reduce inventory. I'm just putting this in for demonstration purposes. And then the debit is going to be to your closing inventory, which is in cost of sales, isn't it? So a credit to inventory reduces the inventory. A debit to cost of sales is increasing your cost of sales, isn't it? Okay. So in order to go through and process that adjustment, what you're going to find that happens there is that now your cost of sales, well, let's draw out your statement of profit or loss. Revenue is going to be untouched, so that's going to stay at the 100, 800. Your cost of sales should now be 70,600, and gross profit should therefore now be 30,200. I hear you shouting, where does the 70,600 come from? Well, if cost of sales previously was this 70,000, you have just debited it, increased it by 600, so you now have 70,600. Your operating expenses are still there at 17,640, and then your operating profit is there, is it now at 12,560? Okay. The other figure that you've got as well is you've got your inventory is now the, what's that? Bum, bum, bum. Was it 3,960 less 600? So that's 3,360. And then don't forget, bit of a trick on the SFP. Your retained earnings were there at 10,480. If you've made an adjustment to cost of sales, you've adjusted the profit, that will go through there as well and reduce your retained earnings by the same 600 amount. So is that the 9,820? Okay, excellent. Let me just double check that. I will use my own calculator. 10,480 less 600. Yeah, 9,880. Thought I had something slightly wrong there. Didn't look quite right, did it? Okay. Excellent. There we go. So you've got most of the information now to finish off part A. So what we need to work out first of all, if I go through and have a look at your ratios. Personally, I'd get the easier ones first. So I'd look at my operating profit margin. That's my operating profit, which is now 12,560 divided by 100, 800. Does that go through there and give me 12.5%? Okay. And the reason why I've left out return on capital employed is that's a tricky one. Let's get your operating profit margin. Net asset turnover, again, quite tricky. Inventory days. So here you take your inventory figure of 3,360. You divide it by your cost of sales. So is that there as your 70600, and then you multiply it by the 365 days. Okay. Does that work out at 17.4 days? Okay. Gearing, debt to equity. Well, you've got your debt figure. Is that there as 14,400 divided by your equity. Bit of a tricky one, that one. 17,000 equity shares. Is it there 5,400 as the revaluation surplus plus 9,880? Okay. Tap that on your calculator. So 17,000 plus 5,400 plus 9,880. Does that give you 44.6%? Again, I'm cheating. I just feel like it today. You've got your calculator there, haven't you? That if you click on it, it will bring up your calculator. Again, for simple ratio analysis, don't do anything crazy and just use your standard calculator as opposed to your scientific. You're more than welcome to use your scientific one. You'll get the same answer, but you need to be brave. Excellent. So I've got operating margin, inventory days, gearing. Again, if you've used your own figures for your adjustment, you'll still get those marked, but I think they're the easier ones to go through and get. Return on capital employed. What do we have there? Well, you take your operating profit margin, which is your 12,560, and you go through there and divide that by your capital employed. So again, what you've got here is capital employed is equity plus your net debt. So the equity is the 17,000 plus the 5,400 plus the 9,880. But don't forget to add on the debt figure to work out your capital employed. So 17,000 plus the 5,400 plus 9,880 plus the 14,400. So you should end up with capital employed is that there of 4,680. And does that give you there, I think, is it 26.9%? Oh, what happened there? Okay. That was an odd one. Must have pressed the wrong button. Okay. No panic, but I've got my return on capital employed at 26.9%. Okay. Last but by no means least is your net asset turnover. So that looks at how efficient we are in generating our sales based upon the net assets used to generate it. So what you've got there is your sales up here on the top. Your net assets that you've got, well, here you've got a bit of a calculation to do. 55,000 plus your inventory, so that's the adjusted inventory figure of 3,360, and then deduct the 14,400. You're not given any other assets. You're not given any other liabilities. You would need to take account of those if they were given, but there's no mention here. So 55,000 plus 3360. Deduct the 14,400. That gives me 43960 as my net assets. And that gives me, is it 2.3 times? There we go. Excellent. So hopefully that goes through and helps you with just the calculations, particularly at the top in terms of what we've gone through and done. So what you've got there, remember, is that the goods should have been sold for 1.5 million. That would have given us a cost of 1.2 million based on a 20% gross profit margin. However, they were then sold for 50% of that cost. So 50% of the 1,200 is the 600 adjustment we need to process. Processing that to closing inventory, we need to go through there and reduce the inventory by the 600 from the 12 down to the 6, and then increase cost of sales. That increase in our cost of sales went through there and had an impact on our gross profit and operating profit, as well as impacting our inventory and then our retained earnings also. Once you've done that, you're away, and then you could calculate the various ratios. Again, get the easier ones first, operating margin. And I think what you then need to bear in mind is that all the other ones, inventory days, gearing, return on capital employed, net asset turnover, will all have been impacted by your adjustment. So don't worry whether your adjustment is right or wrong. Abandon those 2 marks. Come up with a number, process it, and use your numbers. There will be credit given for your own figure marks. And you could effectively then get 5 out of the 7 for calculating the ratios based on your numbers correctly. However, to make sure you get those marks, you need to show your workings. You need to show how you have calculated those ratios. Okay then, so having gone through and looked at part A, whereby we've adjusted for the information in note 3, so that be inventory adjustment, where there was that write down to its net realizable value, and we calculated the equivalent sector averages for our company Bun. We're going to go through in this video and look at part B. So part B, pretty bog standard type of analysis question. We need to go through there and look at the performance, so focusing upon the profitability. So when we're looking at the ratios that we're going to be looking at, we'll be thinking about return on capital employed, operating margin, and net asset turnover. So we'll be looking to discuss those 3 ratios for the average for the industry and also for our company Bun. And then we also need to go through as well, don't we, and look at the position, which is very much focused on the statement of financial position, your assets, liabilities, and equity, whereby we'll be looking at inventory and then your debt to equity, so effectively your gearing. Okay. Again, it's key when you're looking at part B to go through there and understand the industry and then also understand the bits and pieces of information as well as the information given within the financial statement. So I think the first bit to note is that we are a bakery which owns 2 shops and cafes. So there's 2 bits of information in there. First of all, we are a bakery, so we'll sell things such as cakes and bread. And if you think about those cakes, you think about those bread, you know, they're going to have a very, very short shelf life, aren't they? Which you can sort of see for the industry has a short shelf life of 4 days, doesn't it? Okay, so you wouldn't want to be buying cakes or bread that are more than 4 days old. They'd be effectively stale, wouldn't they? And they wouldn't taste too good. The second bit of the information at the top was about owning the shops and cafes. So they are physically our premises. So that's why we might have a relatively high level of non-current assets. But when we're comparing against the industry, do they own the shops? Do they own the cafes? Maybe they lease the assets. So that could have an impact on your profitability, couldn't it? Yeah, if we own the shops, we don't need to go through there and pay any rent. But if you lease the shops, then we will have some rental payments, and therefore that will reduce the profitability. Goes on to say that we've had decline in profitability due to competition. So the directors wish to investigate if this is sector-wide. Consequently, they have got those equivalent ratios which have been reproduced below, and we've gone through there and calculated ours, haven't we? Now, you don't have to do this then in the exam, but this is just for me to as demonstration purposes, so you can make some brief comments. Operating profit margin for us is 12.5. For the industry is 8.6, so we're performing much better than the industry. Inventory days, however, we're not performing so well there. Remember the type of business that we are operating being a bakery, and we have a 17.4 day shelf life compared to 4 for the industry, so that's quite large, isn't it, in comparison? You've then got debt to equity of 80 for the industry versus 44.6 for ourselves, so we are outperforming the industry there with relation to our gearing. Return on capital employed for the industry is 18.6 and we're at 26.9, so we are operating much more efficiently than what the industry is operating at. And then the asset turnover, what's that? Is that 2.01 times, so not too much difference there in terms of your net asset turnover. Okay, so what you can gauge there just briefly is that we're performing better based on our margins. Overall, we're operating more efficiently. We're better in relation to the level of gearing, and we're also, if you like, taking longer to sell our inventory, which could be a bit of a risk, couldn't it, given the type of industry that we're operating in as the baking industry. Okay. We then need to make some points. So various points that we can make out. Nothing massively jumps out from profit or loss immediately. But if you go through there and have a look at your statement of financial position, we do have a revaluation surplus. So the buildings that we own, we revalue. So that will have increased the amount of equity within this business. Does that impact any of our margins? Well, yes. Gearing, yes. Return on capital employed. So that will impact those margins. In part 1, it tells us about the fact that we have revalued the properties. It also goes through there and tells us that the vast majority of our non-current assets, 80% of them, are related to those tangible items of the property, and then the other 20% is relating to a brand. Okay, and then it tells us about our strategy in the current period, in that we began offering discounted meals to customers. Has that strategy worked? You know, the aim was to reduce perishable inventory and reduce inventory holding periods. Well, our inventory days are still at 17 compared to 4, so it may be that that strategy has not been as successful as what we would have originally wished it to be. Okay, so let's just go through, piece it together line by line. So part B, head it up and put in the title there, performance. And we can go through there, can't we? Underline it to show that it is a separate heading, and start off with the overall indicator of profitability. That's your return on capital employed. And I think the key thing to state there is that our return on capital employed is better, so therefore we are operating more efficiently. So Bun's return on capital employed is higher than that of the industry, showing that it is performing more efficiently than the sector. Okay. Now remember, return on capital employed takes account of your equity. Now this is quite maybe a surprise, if you like, how well we're performing above the industry averages. Now if we look there at the fact that we're generating 26.9% compared to the industry's 18.6%, given that we've included this revaluation surplus at 5,400. If we were to remove that 5,400, then we will be performing even better than the industry. So let's state that. Okay. If we were to remove Bun's I can't spell. You'll get used to that. Revaluation of its PPE, then its ROCE will be even higher than that of the sector. Okay, so we are performing efficiently. And the key thing then when you're looking at your return on capital employed is, remember, return on capital employed is split into two aspects, isn't it? It's looking at your net asset turnover and also your operating profit margin. So we can analyze that further. So return on capital employed can be analyzed further using both net asset turnover and operating profit margin to show where Bun is achieving its efficiency. So again, what we can do, you don't have to do this, it's entirely up to you. We can break it down. Net asset turnover Bun's net asset turnover is comparable to that of the sector. There's not really all that much to say. Okay, we're looking there, isn't it? What is it? 2.3 versus 2.0 times. If you wanted to, Bun's net asset turnover is comparable to that of the sector and is very slightly higher. This could be due to slightly higher sales due to the new, what was it called? Discounted meal deal policy. So just using something from the notes. I think the key thing, however, is that this change in return on capital employed is all about your operating profit margin. So here, Bun's operating profit margin is higher than that of the sector, and this is because it is likely to have a better control of its costs, and it owns its properties, and so does not include any rental expense. Okay, there we go. I think that's the key reason why this business is outperforming the rest of the sector, isn't it? Okay. We can then go on to look at the position. So again, as that is a heading, We'll put that underlined. And again, what we're looking at here is your inventory and your gearing, isn't it? Okay. So what we have here is that the inventory holding period is much higher than that of the sector, which highlights that the new policy has not led to a reduction in perishable inventory. Okay. Is that a risk? Yes. So Bun needs to take further action in order to reduce its inventory levels, possibly by reducing the selling price, as otherwise there will be further inventory write-downs. Okay. And that will impact your profitability in the future, won't it? So again, I haven't done anything fancy. I've just stated what we have with regards to our comparison to the sector. What is that showing us? Link back to the information in the question. They wanted to reduce the perishable inventory. How are they going to change that? Well, they need to get rid of the inventory quicker. How do you get rid of inventory quicker? You sell it quicker. How do you attract customers to buy the inventory? Reduce the prices. And if you don't, there's going to be future impacts on the profitability, aren't there? In terms of the gearing for Bun is lower than that of the industry, partly due to the revaluation increasing the equity in the company. Now you've got higher equity, the level of debt to equity is therefore lower, but also because Bun has no directly related finance associated with the ownership of the shops. It mentions that there, doesn't it? In part 1. Okay. There's no directly associated finance, so we haven't had to borrow to go through there and purchase those shops. If we did, we would have increased amount of debt. We have some debt there. That bank loan is just there for other purposes within the business. Here, we own our property. We've revalued it. We've increased the equity. We have a lower level of debt than the rest of the industry. If the rest of the industry does own its property, then maybe they have used debt to finance it. Therefore, they have much higher levels of debt. But again, the key thing that you're doing is for each ratio, you're making at least one comment and making sure that comment is specific to what you have been given within the actual question. Okay. Use the information. Even if you don't know what that information means, use it somewhere. Okay. To finish things off, so you need to finish things off with effectively a conclusion on the performance and the position. I think the biggest risk here, isn't it, is about the inventory. Okay. But remember, the business is performing better than the overall sector. So what have we got there as a conclusion? Bun is performing better than the sector averages, even though its profitability has fallen. Okay, it specifically stated that, didn't it, within the text. However, the new strategy has not the inventory, or not reduced the inventory holding period, and so they need to address this to prevent further reductions in profitability in the future. Okay, there we go. So I've mentioned a little bit about a conclusion to do with the performance, in that we are performing better than the sector averages, even though we have had a worse year. And however, then we've then moved it on to the position and said there, look, the inventory days have gone through there and shown to be higher than the sector averages. We've already had in part 3, wasn't there, a large write-off of inventory which reduced the profitability, and if we don't do anything about that increasing or larger inventory days, then that write down is going to happen again into the future and could be even more significant. Okay, there you have it. So I've written there, what is it, 1, 2, 3, 4, 5, 6, 7 points. That's more than enough there to be able to go through and see you to get a pass. For each point that I've made, 1 or 2 of them will pick up more than a mark, and therefore we'll be getting very close to the maximum of the 10 marks. Okay, if you look at what I've written compared to the model answer, the theme is the same, but what I've written is entirely different. So don't feel as if you have to write exactly what is in the model answer. You just need to put something in that is well structured and linked to what the information is that you have been given within the question. Other than that, that's it for part B. I'll see you all in the next part when we look at the limitations of our comparisons in part C. Okay, so let's go through, finish off the question and answer part C. Part C wants us to go through there and look at the limitations of the comparison between Bun and the sector average ratios provided. 3 limitations, 3 marks, 1 mark each. So the first one, we went through there and mentioned it right at the beginning, is the reporting date, wasn't it? Okay. Bun's got a reporting date of December. The averages were there, was it for June, if memory serves me right? So don't just write reporting dates. We can say that the different reporting dates is a limitation, as we are not comparing like for like in our analysis. This therefore might not show any seasonal variation in the comparison. Okay, the baking industry, it may be seasonal, I don't know, but if you've not got the same dates as a comparison purpose, then you can't compare like for like, can we? And therefore your sales, how they accrue during the year, might have a big impact on your profitability ratios, such as return on capital employed and operating profit margins. Other one I would put in there would be our ratio calculations, because we've gone through there. If we look at the ones we've calculated, big one there, debt to equity for your gearing. Okay, We've calculated the same. Could it be different within the industry? Inventory holding days, we've done the SFP, inventory divided by cost of sales. Could it be your inventory divided by purchases? Okay, so there's dissimilar ratio calculations. So the ratios calculated by Bun may not be calculated in the same fashion as those for the industry. An example being gearing and using debt to equity when it can be calculated also as debt to debt plus equity. Okay. You could also go through as well and put in your inventory days if you want, but I think you're just then going just a little bit too far. The other one that I thought was quite good to get is the fact that you've got a revaluation, isn't there? So Bun revalues its properties and so might have a different accounting policy to the other businesses within the industry. So what? Well, therefore, the ratios may not be comparable. Okay, we're not again comparing like for like. Okay. There's other ones that you can throw in there. I think the model answer mentioned about the properties being owned. Maybe the industry leases those properties, so therefore they will have a rental expense. Bun, our company, won't have a rental expense, so that will go through there and have differences between the profitability, and again therefore it makes it difficult comparing like for like. But what you've got there, I've written it out for you. You can take a screenshot of it if you want. Each of those 1 or 2 sentences for each point that I've written will quite comfortably get you 1 mark, and therefore with 3 points you're going to get yourself 3 marks and 100% on part C, which is more than a pass. So overall as a question, I think it was pretty tricky, particularly part A with the adjustments, but the key bit from part A, remember, is to take whatever adjustment you make and then calculate your ratios even if you have that adjustment incorrect. For part B, assessing the performance and the position, again the key thing to do there is to make sure you use the information from the question, and then you've got there part C. The key bit about part C is it said it wanted you to explain the limitations, so don't just state the limitations, explain them, and again support your answer from the information that's given within the question. If you can do that, you're going to get more than 50% and be comfortably able to pass what was overall a challenging question. And that's it from me. I'll see you all next time for the next question. Good luck.